Hey everyone! Did you know that 78% of Americans live paycheck to paycheck? According to a survey conducted by CareerBuilder and CNBC, 78% of full-time workers in the U.S. live paycheck to paycheck. MarketWatch cites a report by the American Payroll Association stating that 78% of workers are living paycheck to paycheck due to factors such as rising expenses and stagnant wages. And the list goes on. But what if I told you that mastering these 10 personal finance lessons could be the key to achieving financial freedom and living the life of your dreams? If you apply these 10 lessons, I believe will change your life as well. So let's get started. Lesson 1. Start learning about personal money right away. The first lesson is that everything depends on delayed gratification. If you can resist the desire for an instant reward, your rewards will typically be far bigger in the long run. Let's imagine you invest in the stock market. This occurs frequently in the investing industry. The longer the period that you acquire and hold, let's say 10, 30, or even 50 years, the greater your gains will be. This is also the reason that a plethora of financial advisors advise against accessing your savings or 401k. They understand that the longer your money remains in one of those accounts, the more advantageous it will be for your retirement years in terms of making regular purchases. One way to sum up delayed gratification is to simply say, don't buy it if you can't buy it twice. Hopefully that statement makes sense, but if you can afford to buy anything twice, it generally indicates that you're in a solid enough financial position to do so. For illustration purposes, let's say you can afford to buy something for $500, such as a new Xbox or PS5, but the thought of making a larger than $1,000 purchase seems a little worrisome. At that point, I would probably argue that you shouldn't have made the $500 purchase in the first place because it's probably not a smart decision if the $1,000 purchase makes you uncomfortable. Making decisions can also be aided by delaying gratification. When faced with a decision, especially one as significant as changing careers, I've found that when you extend the perspective by 10 or 20 years, the situation usually becomes much more apparent. The second lesson in personal finance is to track 3 numbers, which I like to refer to as the big 3. Your expenses, both your net worth and your savings rate. I find that if you're able to track these 3 numbers and make improvements to them over time, your personal financial position will just get better and better, and there's no doubt in my mind that you will become financially free when it comes to your expenses. Tracking your fixed costs, such as those for housing, utilities, healthcare, and insurance, should be your first priority. Additionally, you want to ensure that it doesn't account for more than 50 to 60% of your income. Things get a little hairy, and you may run out of money in other areas of your budget for things like savings and investments, or even discretionary expenses if they account for more than 60% of your income. When it comes to spending, that is optional. I like to monitor my own spending, so I basically keep a close eye on everything I spend and do periodic checks during the month. Assume that your monthly goal for discretionary spending is $1,500. Then, all you have to do is simply check in. Assuming that you are halfway through the month on the 15th, your discretionary spending ought to be approximately $750. Let's assume that by the 15th day, you have already spent $800, or perhaps even $900. You are aware that, in order to maintain your personal savings rate percentage for the remainder of the month, you will need to make some slight cuts. I would suggest starting with a savings rate of about 10% of your salary and working your way up from there. If you are monitoring your savings rate, you should ideally be more conscious of it, keep a closer check on it, and see an increase over time because greater savings translates into more money for investing and other activities. Take a look around this conflict zone. There are tons of aerobic exercises and step class activities to be done. My mind is racing with it. How many things can we do at this time? In relation to net worth, this is the final figure I prefer to monitor, and the main purpose of doing so is mental well-being. I find that keeping track of it is a great way to gain perspective on your financial situation. Occasionally, I even review my spending log from 2020 or 2021 to see how much my net worth has increased. The realization that you don't really need to invest in too many things is the third lesson that completely changed my life. People frequently buy in far too many stocks and ETFs, a problem I frequently observe in the financial portfolios of my subscribers and some of my acquaintances. For their own benefit, frequently, people believe that investing in, say, 10 or 12 ETFs is a smart idea, but the problem is that these holdings typically overlap. For example, If you took the ticker symbol VO, which is Vanguard's S&P 500 ETF, and then you also bought VOE, which is Vanguard's Midcap Value ETF, you can see that 92.1% of V's holdings are already in VOO. So while you think you could be diversifying your portfolio by investing in a bunch of ETFs, you could actually be doing the opposite and probably doing more harm than good. Most post-index tracking ETFs are super simple and very well diversified. So oftentimes you just need 1, 2, or maybe even a maximum of 3. And if you're having way more than that, you might just be making it more confusing for yourself. Investing should be simple and passive, and most casual investors that just bought an S&P 500 ETF, for example, over the past 15 years, would have outperformed 92% of large active fund managers, according to S&P Global. Personal finance lesson number 4 today is to be aware of big purchases that are depreciating assets. As everyone knows, cars lose value with time, but other items also lose value. Watches, jewelry, clothes, books, cell phones, and even computers. On one of these assets that is losing value, you are investing money. The worst thing you can do is actually take out a loan to finance it. In this case, you are paying a high interest rate to a bank, for example, in addition to financing your purchase, but you are also financing an item whose value will eventually decrease. In this instance, you are paying money to lose money. Now, by items, I usually mean clothing, accessories, or even furniture. Really, when was the last time you made a purchase? Assume a new couch costing $2,000 that you decide to sell on Facebook Marketplace 3 years later for $200. Not only have you lost $1,800 on your purchase, but it's possible they won't even make it to pick it up. Have you ever had a Facebook conversation with someone? Marketplace. They genuinely promise to arrive, then abruptly disappear. The whole thing is an emotional roller coaster. Enough of Facebook Marketplace, let's get into personal finance lesson number 5, which is that if you invest for more than 20 years, it should typically yield a positive return. There's a compelling case for retail investors to stick with their investments for a long time in the famed blog post from Dollars and Statistics. He notes that he uses the price-to-earnings ratio, PE ratio, to determine whether a stock is expensive or not. In general, though, as the PE ratio increases, stocks' future returns tend to decline. This makes some sense. For example, purchasing an overpriced stock will likely result in a lower return than purchasing an undervalued stock. You can also observe that there is a negative correlation between the increase in PE ratios and the price of stocks and your returns over the next 5 years. But the fascinating thing here is that as long as you hold for a longer period of time, you can see that as the years pass by 5, 10, 15, 20, 25, etc., the number of red dots slowly decreases. The author basically tells us that if we want to accumulate no matter what, we should just keep buying into the stock market. He claims that over any 20-year period, U.S. stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. It's improbable that we will see a loss of capital as long as our holding time is extended beyond 2 decades. People frequently believe that the stock market is overpriced, which leads them to make no investments at all. In order to emphasize this point, the author provided a really good example in his blog post. For instance, if you search for stock market overvalued 2012 on Google, a number of articles describing the then current investor belief that the market was overpriced by 50% will appear. However, if you look at this graph of the S&P in 2012, it was trading at about 1,400 levels, and if you had believed that the market was overpriced at the time, you would have missed out on some significant gains over the previous 10 years. Personal finance lesson number 6 is that saving money is very important, yes, but at the beginning, it's the most important. A less evident issue is that people tend to believe that success in business or investments equates to financial success. However, in situations where resources are scarce, the most prudent course of action is to save aggressively and consistently. The fundamental point of this is that you want to accumulate an initial nest egg that will grow for you in the future and allow your money to generate income on its own. The first $100,000 will likely consist more of savings than investment returns, as is well known. Using this calculator from the 4-Pillar Freedom blog, you can see that after 6 years, if you save $13,000 annually and earn a 7.5% return on your savings, you will have $101,000. But here's the catch. After 6 years, you will have exactly nothing. Of that $101,000, savings will make up 77%. In an alternative scenario, let's imagine you save $10,000 annually and you're getting an even better return. That means that even though 10% of your money will require 7 years to yield a 10% return, at the end, your savings will still make up 67% of your total balance of $104,000. Since compound interest works best when all friction is eliminated at the outset, any money you save now will be worth much more later on because it will be compounding and working for you. It just takes a lot of discipline, savings, and diligence to start your first nest egg, so if you're new to it, just keep at it. There really is no secret to getting over the hump. Lesson number 7 that transformed my life is that investing should be boring. It is unlikely that day trading will make you wealthy in the short term, but investing in an index fund and sticking onto it for a long time, let's say, and then forgetting about it will. I want to share with you guys a snippet from my podcast with the Psychology of Money author Morgan Housel, and it is really genius.
Your book taught me that successful investing is when you lose the password to your investment account.
Yes, that's exactly it.
I don't actually think you said that in there, but that's like, when I lose the password to my investment account, I'm so proud of myself.
Yeah.
Because it means I haven't checked it in forever.
And I believe that this is actually true. If you invest for 10, 20, or even 30 years, you should strive to forget the passwords to your investment accounts as long as your portfolio is well diversified. Horizon and beyond. Holding on to those investments and keeping an average of their dollar cost is the ideal course of action. This calls for ongoing contributions and investments. This tactic is mediocre and dull. I understand, but pay attention to the following quotation from the same podcast, which explains why you should strive for average returns rather than trying to outperform the market.
It's extremely hard to beat the market, and very few people will do it. But I think there are really smart people who can do it, and people who I know who I could invest with. The reason I don't is not because I don't believe it can be done. It's because the variable that I want to maximize for in my investments is endurance. If I can just earn average returns for an above average period of time, it's going to lead to an amount of success that will literally put you in the top 5% of investors.
And there you have it, the top 5% of investors, all from simply being mediocre and doing routine things like putting money into an index fund and taking it slow. Personal finance lesson number 8 today is to not pay attention to your peers, not in terms of life. While it's important to pay attention to them, avoid putting yourself in their shoes. It's easy to compare yourself to other people in your life, including friends, co-workers, or even individuals your own age, when it comes to personal finance, but this is a lifetime endeavor. Even with social media these days, it will always be in your face. However, it's crucial to keep in mind that everyone is on their own path, that you and your friends may have very different situations and goals, and that these people on social media don't even give a damn about them. They're really just presenting you with the high points of their lives. You have no idea what goes on behind the scenes. In all honesty, nobody is going to approach you and pull out their bank account, saying, "Hey, look at how much money I have. You should be ashamed of yourself, you know?" No, that won't take place. Making comparisons is a pointless use of your time and mental energy, which could be better spent on yourself. While some people enjoy saving money, others want to spend it all, and there are those who fall somewhere in between. Additionally, everyone has various values when it comes to spending. Though it's easier said than done, I've noticed that my tendency to make fewer impulsive purchases decreases when I stop comparing myself to other people. Personal finance lesson number 9 today is along the same vein, and that is to avoid becoming a $30,000 millionaire. This is a term I picked up in Texas. According to the Urban Dictionary, a $30,000 millionaire is someone who earns $330,000 a year but presents themselves as a millionaire. For instance, take a look at this 30K millionaire who owns a lawn BMW and still resides with his parents, or someone who attends a club and pays for a VIP table but isn't able to purchase drinks because they spent all of their money on the table. Whoa, a millionaire for $30,000. Thus, the takeaway from this is that individuals who appear wealthy most likely don't have any money at all, and the wealthy individuals who do have money will not even pretend to be wealthy. A survey of millionaires revealed that the majority of affluent individuals live well below their means, which is how they initially became wealthy. The most famous remark from the book The Millionaire Next Door is this one: "If your objective is to become financially secure, you will probably succeed. However, if your goal is to generate money so you can afford to live a luxurious lifestyle, you will never succeed." It serves as a helpful reminder that if we set realistic objectives and stick to our budget, we will most likely achieve financial security and independence. If you want to avoid becoming a $30,000 millionaire, this is definitely what you should aim for. Personal finance lesson 10 that changed my life is that it's not risky for someone else to do what's risky for you, and vice versa. Just like not comparing yourself to others, don't make the same decisions as somebody else just because they do it. You will, after all, have a significantly different risk profile than, say, your neighbors. If you're receiving financial advice or information from anyone, you should make sure you're conducting your own research and determining whether or not it makes sense for you. There is no one-size-fits-all approach to general advice, so whether it's from this channel or any other YouTube channel you come across, you should always be asking yourself, is this decision right for me? It doesn't bother me if you draw inspiration, ideas, and jumpstarts from friends, internet TV, or other sources. That's perfectly okay in my opinion, but it's also acceptable if you truly want to consider the consequences of the decisions you make for yourself. These are my top 10 lessons learned about personal finance. Tell me. Please remember to hit the subscribe button on the channel, located underneath the comments area with whatever views you have.